This video is an urgent warning for all investors that it looks like we are on the precipice of a global margin call. I do not like making videos like this where I'm giving an urgent warning about something happening in a very short time frame, but there are just too many warning signs happening, flashing red right now for me to ignore. If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I teach active investors how to get higher returns while taking on less risk with their portfolios by learning how markets work and understanding how to be prepared for moments like this. So first, what is a margin call? There are three things necessary for a margin call to happen. Number one, you borrow money in order to buy something. Then that thing that you buy goes down in value. The third thing that happens is that the person you borrowed money from to buy that thing forces you to sell that thing so that you can pay them back the money that you borrowed. The moment that they force you to sell to pay them back, that is the margin call. Now, most investors are going to be most familiar with margin inside their brokerage account. For instance, an investor who's very bullish on Apple may have bought 100 shares of Apple at $100. Now, if the investor didn't want to put up the full $10,000 for that purchase, they may have borrowed money from their broker in order to make that purchase. So let's say they borrowed half the amount of the purchase and they spent $5,000 and borrowed the other $5,000. In a perfect world, they would have written that up to $200 per share, selling 50 of the shares at $200 for the proceeds of $10,000. With the proceeds of $10,000 they got from the sale, they take 5 of that, pay back the margin loan, and use the other 5 to pay themselves back for what they used to buy the stock. But remember, they still have 50 shares left, so at this point they're just playing with house money. Now, this sounds nice in theory, but we all know that in practice it could have gone the exact opposite direction. Take, for example, the stock Coinbase. If an investor had decided to buy Coinbase instead, and they waited for the initial sell-off, and then upon the next rally, they thought that all the selling was done, they decided to load up with leverage and buy shares of Coinbase on margin at $350 per share. At some point, as the stock fell, their broker would have called them and forced them to sell the stock. Because if I borrow $5,000 from you and use $5,000 of my own money to buy a stock and then it goes to zero, I won't have anything left over to pay you back. So your broker's going to want to make sure that they force you to sell in just enough time so you at least have enough money to pay them back. But here's something that most people are not aware of. Debt is purchased on margin to a greater extent than equities. That's right. If you're buying things like bonds or treasuries, you can use leverage to buy that debt. And yes, debt itself is leverage. So you can use debt to buy debt. This is debtception or leverageception. For instance, at Charles Schwab, a discount broker with $7 trillion in assets under management, the average retail investor can buy treasury bills and only have to put up 10% of the cost. That's right. If you want to put $100,000 into UST bills, you only need 10 grand. And that's just your average retail small investor can do this. And after the purchase, the price of those T-bills can go down to the point of you only owning 4% of the market value before you'd be forced to sell. So debt markets around the world are much more highly leveraged than equity markets are. And the real trouble here comes from major financial institutions, especially banks that deal in dollars all around the world are dealing in something called the Eurodollar System. Now, I've made in-depth videos about the Eurodollar System before, but Eurodollar is a bad name. Really, the Eurodollar System is any time outside of America there's a financial institution with a dollar IOU. Now, here's how that happens. When anybody in the United States purchases something from another country, we send $1 to the bank account of the person we're buying that thing from. So now there's $1 overseas that exists outside the scrutiny and the oversight and the regulation of the Federal Reserve. Now, that dollar is an asset for that bank, and so that bank can make a loan on that dollar. So that bank with that dollar makes a loan, and that loan is dollars that land in somebody else's bank account. And when those new dollars that were just loaned into existence land in somebody else's bank account, those are new assets whereby new loans of dollars can be made. Now, the reason this is a problem is number one, because nobody actually knows the extent to which this has happened. There are estimates globally that there are upwards of $65 trillion in hidden dollar debt around the world. And these financial institutions right now, especially the ones in Europe, are not in the best shape. Their balance sheets are in trouble and they're holding a lot of assets that are underwater. They're in way worse shape than American banks. And in March, some of the American banks even started to fail, which means at any moment there could be a catalyst that some of these financial institutions around the world will be forced to liquidate their assets, which is distressed debt, in a scramble for dollars, which are just dollar IOUs. But that's only half the story. Interest rates are on the verge of breaking out, with the US 30-year Treasury yield at the highest it's been since 2011. The 10-year is in the same position, being at the highest interest rate since 2007. And considering the chart pattern, technical analysis here would suggest that this is on the verge of a breakout, meaning interest rates at the long end of the curve could be headed much higher very soon. Now, by now, you all know that the relationship between yields and bond prices are inversely correlated. The interest rate on a bond is simply a function, it's a product of the price of the bond. So if it costs you $100 to get $101, that's a 1% interest rate. If it costs you $50 to get $101 back, that's a 101% interest rate. So as yields go higher, that's the same thing as saying bond prices are moving lower. The chart setup is primed for bond prices to collapse as interest rates and yields skyrocket. But is there any catalyst that would force this to happen? Well, let's consider 4 major players in the US Treasury market that are all sellers right now. Number 1, we have China, who 10 years ago held $1.3 trillion in US Treasuries, while today only holds $835 billion. And this sell-off is only just getting started. My last video was about all the problems that China is having right now. Their economy is literally imploding. They are dealing with it by lowering rates and printing money, which is hurting their currency. As a result, they are being forced to sell more US Treasuries, which is something they were already wanting to do, as a way to raise capital to help out with their economic situation. So the second largest holder of US Treasuries, China, is already a big seller and is very likely going to start selling even more very soon. But there's a bigger player than China, and that's Japan. Japan currently has $1.1 trillion worth of US Treasuries. Unfortunately, Japan is in a very similar economic situation with a massive whopping 260% debt to GDP ratio. Their currency versus the dollar is also collapsing. Meanwhile, they're trying to get out of yield curve control, which is something they've been trapped in for a long time now. They're also dealing with a population implosion. And this $1.1 trillion worth of assets is looking pretty juicy to Japan right now as a slush fund to start to sell, which is something they've already been doing. In the year 2022 alone, they dropped from 1.3 trillion of US Treasuries down to 1.1 trillion of US Treasuries. So outside of the US, the largest holder of US Treasuries, Japan, and the second largest holder, China, are both selling. Big money selling, pushing prices down, catalyst for rates going up. But that's not all. Remember in 2021 when the Fed started talking about tightening and the common response was you can't taper a Ponzi? Well, the Federal Reserve's balance sheet would like to disagree. And while the tightening over the last couple of years has been nothing compared to the easing they've done in the past, it is undeniable that their balance sheet is absolutely moving lower. The last time it was this low was July of 2021. Seeing as how the balance sheet is worth about $8 trillion right now, the Federal Reserve has quite a bit of US Treasuries, and they are not on net buyers of these treasuries right now. When the Fed's balance sheet is declining, that means they are letting these assets bleed off their balance sheet, aka they are letting some of these bonds get paid back and not rolling over that debt. By the way, guys, I'm going to be speaking at the Stock Pulse Silver Symposium about the history and future of sound money. It's in Las Vegas from September 29th through October 1st. There's going to be a ton of other great speakers there. There are going to be plenty of opportunities for us to do meet and greet, hang out, get some drinks together. I would love to meet you there. And everybody who shows up is going to get 1 ounce of silver as well, a 1 ounce silver coin. So I'd love to see you there. There's a discount link, 10% off in the description below. So sign up there, get that discount, and tickets are running out, so sign up soon. Now, many people are expecting a Fed pivot very soon, but what is more likely if they move that direction at all is just a Fed pause, meaning they'll stop raising interest rates. But they've been very clear they will still continue to dwindle down their balance balance sheet and let their assets on their balance sheet decline even if they stop raising rates. So in all likelihood, this will continue. So now we have China, Japan, and the Fed all selling. Selling what? US Treasuries, bonds. And finally, the biggest player of them all, the US government. It's important to understand right now, before we move on, that governments borrowing debt is the same thing as selling debt. When existing debt gets bought and sold, the only thing that's happening is you're changing hands who the debt is owed to. When new debt is issued, meaning the government borrows more money, it requires a buyer. Or in other words, it requires a lender. It's the exact same effect as somebody else who holds existing debt deciding to sell it and needing somebody else to come in and buy it. So as the government borrows more and more, that's the same effect as existing debt getting sold. It's downward pressure on prices, upward pressure on rates. As unusual, Wales shared on Twitter recently, this chart shows the Congressional Budget Office's projections of US public debt. And by their own projections, the US government is going to borrow $5.2 billion every single day for the next 10 years. This is the Congressional Budget Office estimating over $5 billion of borrowing by the US government every day for the next decade. And yes, they make projections like this all the time, and almost always they are underestimates of what turns out to be reality. This would put total national debt above $50 trillion in the next 10 years. So what does this all have to do with a margin call? Well, the biggest money in the US Treasury market right now are all sellers. This is why it looks like interest rates are about to break out to a multi-decade high, as bond prices look like they're ready to fall off a cliff. What do we remember from the beginning of the video about when prices fall on something that is leveraged? Margin call. You get forced to sell. Debt markets are the most over-leveraged markets in the world. Debt itself is leveraged, but all debt, for the most part, around the world is purchased using leverage as well, simply because it is viewed as risk-free. But what happens when that risk-free asset falls to a price below the point at which the lender is comfortable with you hanging on? Well, you get forced to sell. And when everybody starts getting forced to sell, that pushes prices down even more, which means everybody else also starts getting forced to sell as well. Now, despite the recent sell-off in recent weeks of the S&P 500 and other major stock indexes, stocks are still near all-time highs and majorly overvalued. Considering all of the economic risks piling up all around the world, valuations in equities are nowhere near where they need to be. Now, normally, traditional financial advice would tell you that stock performance and bond performance is inversely correlated. That's why they tell you to have a 60-40 portfolio, so that when your stocks go up, your bonds don't, but your stocks help out your portfolio performance. If we get a stock market crash though, then your bonds will go up because everybody's selling stocks tends to buy bonds. They tend to balance each other out, right? But what happens when that stops working? I'll tell you what happens. You get a stock market crash right at the same time as you get a bond market crash. When a margin call happens, people don't sell what they want, they sell what they can, and they sell the things that have the biggest gains so they don't have to take losses at first. With equity markets being near all-time highs, many investors still have gains in many stocks, especially tech stocks, which means that a forced sell-off in bonds could absolutely easily trigger a crash in equities. Now, I'll give you a caveat here. There are many people who disagree that both a sell-off in stocks and bonds and treasuries will happen at the same time. If we start to see a sell-off in stocks and corporate bonds, then there's going to be a flight to safety and everybody buys treasuries, and that pushes interest rates yields down on US treasuries. It's possible that could happen. But as Ray Dalio pointed out recently on LinkedIn, the last couple of years have resulted in a shift in wealth away from the public sector into the private sector, which has left the government's balance sheet in bad shape. Now, this reminds me of a scene in Batman Begins, Christopher Nolan and Christian Bale's Batman movie. At the end, when Commissioner Gordon looks at Batman and says, "What are you going to do about escalation?" Batman says, "What do you mean escalation?" He says, "Well, we use bulletproof vests. They use armor-piercing rounds. You start dressing up like a bat. Now you get a clown dropping Joker cards everywhere." Well, the same thing happens with intervention in economies. Escalation over time, sowing the seeds for greater crises that result in greater intervention. You start off with the Greenspan put, lowering rates to soften the blow from the dot-com bubble burst. You sow the seeds for the housing crisis. When that blows up, it's not enough to just lower interest rates. You also have to start QE and bail out the banks. Well, that all sows the seed for an even greater bubble that comes to a head at the end of 2019, early 2020. And when that thing blows up, again, it's not enough to do what you did last time, which was lower rates and QE and bail out the banks. Now you have to lower rates all the way to zero, QE like crazy, and you can't just bail out the banks, you have to bail out everybody. Further than that, you shift where the risk lies. In the beginning, it was with dot-com companies. Then it was with more people in the economy and households and banks. Then it was with the entire economy. But now where has this escalation risen to? The central government itself. From absorbing all of the risk of the entire system from all the last bailouts put together, it is now in the worst position of all. It does not seem to me more plausible that we have a flight to safety into treasuries rather than a sell-off of treasuries as the main problem here. Which means this flight to safety is more likely a flight to dollars, as assets including treasuries and corporate bonds and stocks all get sold off together. This would lead to a mad scramble for dollars and a spike in the dollar index. And especially globally, as most dollars that exist in the Eurodollar system are simply IOUs for dollars, this mad scramble for dollars could happen very quickly and be extremely severe. So what to do about this? Well, number one, I am certainly not suggesting to sell everything and to move to cash, because I could definitely be wrong. And even if you made that move, there's no guarantee that the resulting crash or calamity would make you profit by moving to dollars inside of a brokerage account or into a bank account. If it weren't for the last bailout with Silicon Valley Bank and First Republic Bank, those depositors who were in cash in those banks would have still been screwed even though they had cash. Because at the end of the day, pretty much every dollar that exists is just a dollar IOU. So I'm certainly not suggesting trying to time the market. But when risks pile up this high, I think it is imprudent to not be hedged. Even in normal markets, in normal times, it is prudent to be hedged so that if something crazy happens, you can take advantage of it. And at the very least, be ready to buy things when they're on sale. And then if you're wrong, you're not net short and you still get to experience the upside. We are in a new economic cycle. The next 40 years are going to look very different than the past 40 years. But the past 40 years was one where bond yields were falling for 4 decades straight. That was preceded by an era where bond yields were rising for 4 decades straight. And by every measure, we are moving into a new era that will look like the 40 years preceding the last, which means what worked from 1980 to 2020 will not be the same as what works from 2020 to 2060. It's no longer sound advice to throw money into a passive index fund, bury your head in the sand, and just hope it's there for you when you're 70. Investors today have to be smarter. They have to be active and they have to be hedged, ready and waiting and prepared for these opportunities. When things crash, their hedges pay off, then they can take advantage of assets that are on sale. I invite you to join me and all the members of Heresy Financial University who are learning to do exactly this by allocating their portfolios in a way where they don't have to be worried about these crashes, but they're actually prepared and ready to take advantage of them. Link is in the description below if you're interested in becoming a member. As always, thanks so much for watching. Have a great day.